If you're a business owner in the UK, there's one question you've probably asked yourself 1,000 times. How do I take money out of my company without giving a massive chunk of it straight to the tax man? It's a critical question, right? It directly affects what you actually take home. That's exactly why the expert tax advisors at My Tax Accountant have put this guide together, to give you a really clear look at how UK dividend tax works. So, let's get straight to it.
Let's start with a number, 21.8%. What on earth is that? Well, imagine for every £100 of profit you decide to pay yourself as a salary, that's nearly 22 quid that just vanishes in national insurance. And that's before you've even paid a single penny of income tax. It's a huge slice of your hard-earned profit just gone. For so many entrepreneurs, this is the biggest tax headache they've got.
So, this leads to the obvious question, doesn't it? The one we hear every single day. Surely, there has to be a smarter way to do this, a more tax-efficient way to get paid. Well, there is. And for most limited company directors, the answer is all about understanding how to use dividends properly.
To get you there, we've laid out a simple roadmap. We'll start with that classic debate, salary versus dividends. Then we'll dive into how dividend tax actually works. I'll show you a real-world example of that tax-efficient sweet spot. Then, and this is vital, we'll cover the correct legal way to do it, what's new from HMRC, and finally, we'll answer a massive question about getting a mortgage.
Right, first up, you have to understand the basic difference between a salary and a dividend. It is the absolute foundation of extracting your profits smartly. Honestly, getting this right from the start changes everything for your take-home pay.
And here's that key difference laid out. A salary on the left gets hit not once, but twice by both employee and employer national insurance, but look over on the right. Dividends, completely free from national insurance. This is the game changer. This is the main reason this strategy is so powerful. It's a direct saving that puts more of your own money in your own pocket.
Okay, so we know dividends dodge that hefty national insurance bill. Fantastic. But how are they actually taxed? Let's break down the exact numbers and allowances for the current 2026/27 tax year.
The first number you need to burn into your memory is £500. This is your annual dividend allowance. It means the first £500 of dividend income you get in a tax year is 100% tax-free. Doesn't matter what else you earn. It's not a huge amount, but hey, every little helps.
Right. For any dividend income you take above that £500 allowance, the tax rate you pay depends on your total income for the year. The way to think about it is your dividend income gets stacked right on top of your salary. So, for 2026/27, the basic rate is a pretty low 10.75%. Then it jumps up to 35.75% for the higher rate and 39.35% for the additional rate.
So that's the theory, but how does it all fit together in practice? Let's walk through a really common, real-life example to see how you can combine these two things to find that tax-efficient sweet spot. You'll definitely want to hear this part.
Okay, here it is, the most popular strategy for UK company directors. You pay yourself a small salary of £12,570. Now, why that specific amount? Because it's exactly the same as your tax-free personal allowance. That means you pay zero income tax and barely any national insurance on it. You then take all the rest of your income as dividends, taking advantage of those much lower tax rates we just looked at.
And this just shows you perfectly how it works. Let's say a director wants a total income of £57,570. First, that salary of £12,570 is completely covered by the personal allowance, so no income tax there. Great. Next, they take £45,000 in dividends. The first £500 of that is tax-free thanks to the dividend allowance. Then the next big chunk, £37,700, falls into the basic rate band, so that's taxed at 10.75%. The final little bit, £6,800, just tips into the higher rate band, and that's taxed at 35.75%. Add it all up, and the total tax is just £6,481. Simple.
Now, saving all that tax is brilliant, but it's completely pointless if you don't do it by the book. And this is an area that catches so many people out. You see, paying a dividend isn't as simple as just transferring some cash from your business account to your personal one. You absolutely must follow the correct legal procedure.
Here are the 4 steps you can't skip. First, and this is the big one, you must have enough retained profits in the company. You can't pay a dividend with money you hope you're going to make. It has to be from profit you've already made and paid tax on. Next, you have to formally declare that dividend and record it in your board minutes. Then, you issue a dividend voucher for each shareholder. This is your paper trail. Finally, you make the payment and record it properly in your accounts. It's about good governance, not just tax planning.
So let me give you a massive tip here. Never, ever skip the dividend voucher. Do it for every single payment. Documentation is everything. Think of that voucher as your shield. If HMRC ever investigates, that piece of paper is what proves the payment was a legal dividend, not just you taking money out of the company. It's your legal defense.
Okay, so you've got the strategy, you've got the process. But you need to stay with me on this next point because it affects pretty much every small business owner in the UK. HMRC is now paying much closer attention to how directors are paid, and the rules have changed.
This is the key change. From the 2025-26 tax year, that old way of just putting a single total figure for all your dividend income on your tax return, that's not good enough anymore if you're a director of an owner-managed business. HMRC wants a much clearer picture of where that money is coming from.
Specifically, you now have to report all of these details on your self-assessment tax return. You need the company name and registration number, your exact percentage shareholding, and the precise amount of dividend income you got from that specific company. It's a very clear signal that HMRC is trying to connect the dots between a director's income and their company's books.
Okay, let's tackle a question that causes a lot of stress for business owners using this low-salary, high-dividend model. It's a really practical, real-world worry, and we need to face it head-on.
Here's the question. If my salary on paper is only £12,570, is a mortgage lender even going to take me seriously? And it's a completely fair question. It can be the thing that stands between an entrepreneur and buying a family home.
And his simple answer is no. It absolutely should not harm your chances. Most mainstream lenders are completely used to this income structure for company directors. They don't just look at your salary. They assess what you can afford based on your total income. That's your salary plus your dividend. The key is just to be prepared. Have your documents ready. 2 or 3 years of company accounts, your SA 302 tax calculations from HMRC, and, you guessed it, those all-important dividend vouchers we talked about.
Right, before we finish, a very quick but very important disclaimer. We've put this together as a general guide to give you a clear overview of the rules, but it is not a substitute for professional advice that's tailored to your business. Tax is complicated, so please always speak to a qualified advisor before you make any financial moves. And on that note, if you want that kind of tailored expert advice, the team at My Tax Accountant is ready to help. They can look at your specific circumstances and build a tax strategy that's both efficient and, crucially, fully compliant. To book a consultation, just get in touch using the details on the screen.
So, does the low-salary, high-dividend strategy still work? For many, the answer is a definite yes. But with more scrutiny coming from HMRC, the need to have all your ducks in a row has never been more important. For more clear, practical tax insights for your business, don't forget to subscribe to the My Tax Accountant channel. Thank you for your time.